First-time homebuyers often wonder how much money they need in order to buy their first home. The answer, of course, is it depends. These costs can be broken out into three categories: down payment, closing costs, and post-closing asset reserves. Down payment. Down payment is the portion of the purchase price or appraised value that a home buyer pays up front when they close on a home. If you already own a home, the general rule of thumb is properties require 20% down payment to avoid private mortgage insurance. First-time home buyers typically have options to put 10%, 5%, or as little as 3% down and still avoid paying the monthly premium for private mortgage insurance. Which option a borrower qualifies for depends on each financial profile, the subject property, and other factors. This helps first-time homebuyers purchase their first home without having the benefit of equity in a current residence or the financial penalty of private mortgage insurance. It also allows first-time homebuyers to build equity they can later use for a down payment for the purchase of another home. There are also government loan programs that possibly offer as low as 0% down. These programs are only available to certain veterans in designated rural development areas. In some cases, a lender may allow a portion of the down payment to come in the form of a gift from a family member. The allowed amount will depend on the scenario, and the individuals giving the gift will need to sign a letter stating there is no expectation of repayment. Closing costs. Closing costs are fees and other costs charged by a lender related to a given loan. Examples of closing costs are appraisal fees, credit report fees, title search fees, title insurance, lender fees, and prepaid items such as real estate taxes or homeowners insurance. Closing costs differ from lender to lender and often range between 2% and 6% of the loan amount. This is a general rule, and closing costs could be more or less than 2 to 6% of a given loan amount. Post-closing asset reserves. In addition to down payment and closing costs, lenders also want to verify you have sufficient liquid assets in post-closing reserves. Reserves show the lender that the borrower has sufficient funds in reserve in case there are unforeseen expenses that might impact their ability to make mortgage payments in the future. Oftentimes, these are calculated relative to your monthly mortgage payment amount, principal, interest, real estate taxes, homeowners insurance, or other fees and insurances. A lender may require 0, 2 months, 6 months, or possibly more left over in a borrower's account post-closing, depending on a bevy of factors. If you have any questions about items we've discussed, or you want to explore options about your specific scenario, you can reach out to Saco and Biddeford Savings and discuss with one of our knowledgeable loan officers.